Now, the Central Bank of Nigeria is expected to roll over maturing treasury bills worth 60 billion naira in today's primary market auction. Gbemisola Bello-Aromire, fixed income dealer at UBA, now joins me to discuss sentiments in Nigeria's fixed income and FX markets. Gbemisola, a pleasure to have you join us on Closing Bell West Africa. So could you talk us through what significant happenings we saw at the fixed income and FX space today?
Thank you for having me. Because of the PMA auction today, the treasury secondary market opened on a rather quiet note. Because they will be auctioning 91 days, 182 and 364 days. A total of 59 billion is expected to be rolled over from the calendar. However, judging from the outcome of the last auction, where the DMO successfully raised over 142 billion, we have a feeling that we'll see a repeat of this action at today's auction. Rates at the previous auction, which was at 2.50, 2.8, and 3.84 at the three different maturity, will most probably peak a little higher at today's auction. As long as government needs more funds to augment their local borrowing, we expect that this auction will see significant sale. For the bond market, it remains slightly bullish even after. Sorry, go ahead.
Go ahead, please. Go ahead.
Okay, sorry, I was just going to give a quick roundup on the bond market. The bond market, too, remained rather calm, but with slight bullish trade, even after the inflation figures which came out last week. We still see demand at the bond end. It still seems to be the only attractive investment outlet for investors as we speak. We see rates at that end between 8% and 11%, and we still see a lot of active buys on the bond end.
So your projections earlier about the market's possible response to the PMA did bring to mind projections about how, in the first place, the market must have responded to Nigeria's April inflation figures.
Well, for the inflation figure, the market actually didn't react as much because the expectation was it was going to tick slightly higher. This has been priced in. There's already a negative return on investment. Seeing that the NTB level of at sub 3% level, and the OMO bills are at sub 6% level. This is way below the inflation figures, which, however, has driven the market to the bond segment, which we have between 8% and 11%. So, therefore, we can see the market didn't really react significantly to the inflation figures as they still bought at the bond secondary market.
And ahead of the Monetary Policy Committee meeting tomorrow, what are your expectations and possible projections for impact on the markets?
Okay, this is the third MPC for this year, 2020. I expect that the committee would most probably leave the MPR rate at 13.5%. The CBN is also most likely to maintain all other parameters. Even though these are desperate times with inflation inching up, liquidity, which plays a major role in the direction the interest rate will go, CBN has been able to use other tools to control it. The CRR, which has been used on a weekly basis now, has been used to mop up over the week. Between the last MPC and now, CRR has been used significantly to control money supply and a bit of OMO auction. The market is expecting trade as usual, as we expect the rates to remain at 13.5% and maintain at all asymmetrical corridors.
So talking about liquidity, CRR being definitely two of the biggest elephants in the room to be discussed tomorrow, what other issues do you reckon the committee would have to decide on? I'm thinking stability of the exchange rate, for example.
Well, if they've been able to use the CRR to mop up excess liquidity, then we won't have you won't have significant naira chasing the dollar. The worry had been that if there was too much liquidity, we would have a jump in the exchange rate. However, because of last week we had retail intervention, we had FGN bond funding, and we had 2 days of CRR debit. This has made liquidity to shrink. So this is what could have had a significant impact on FX because we would have to. And the other alternative would be for investment in foreign exchange. But because liquidity is tight, we see slight stability in the FX market.